Hey folks, it's been a while since I've made a video and I just wanted to address that real quick. So if you guys don't know me, I'm actually a college graduate student and right now I'm going to school for accounting and I'm trying to get a master's. So as you would imagine right now, this is finals crunch time. So yeah, I've been a little bit busy. I haven't been able to make videos, but I did want to make it up to you guys by making this video right here about Stanley Black& Decker. Now, if you also know me, you probably know that I don't recommend stocks very often. I'm a pretty cautious guy. I don't really like to tell people, hey, go and buy this right now. I'm not that kind of person. I'm generally just telling you, hey, this might be a good buy, maybe not, but here are my reasons. So that's essentially what I'm going to do today. This could be a great buy, it could be a horrible buy. But what I do want to start off by saying is if you are going to invest in individual stocks in this environment that aren't necessarily like the top 10 positions in the S&P 500, make this a low portion of your portfolio. Like I'm talking like 1%. That way, if things do go bad, you're not going to see a lot of pain. So let's just walk through the stock right here. So Stanley Black& Decker, this is not your sexy tech stock, okay? This is basically a company that makes power tools. And right now, this stock has fallen so much. So right now, I'm going to go on a 10-year week view. As you guys can see, we are at pandemic lows. I mean, right here in the pandemic, this fell all the way down to like $70. We fell that low. Now it's kind of rebounded a little bit. Now it's at $86.54. And, it's fallen quite a bit. So if we're going to go on the yearly time frame, the 1 day, 1 year, well, right here, we are looking at a pretty high RSI right before earnings. So we're looking at 64.45. So maybe it does pull back a little bit, okay? But, it's fallen quite a bit. So, let's just go over to the 10-year 1 day. Now, if I have this anchored view up right here to the all-time highs, you can see that we are significantly below that. We also have this major gap zone right here. So, if we were to fill this gap, that would pretty much go all the way up to around 136.71. So that is a massive gap that could get filled. Now, there's a lot of things that I want to talk about. So now we're just going to move over onto why is this stock falling. So I got this Motley Fool article right here, and it's basically talking about the reasons why it's falling. So right here, it says the company's problems lie in a combination of stronger than expected raw material costs, supply cost inflation, and rising rate environments, putting severe pressure on housing-related discretionary spending for items such as DIY tools. So that makes sense. I mean, if interest rates are stupid high right now, and if nobody really wants to buy houses, and they're all pretty much just sitting on their hands waiting for interest rates to drop, then yeah, of course, there's not going to be a whole lot of do-it-yourself maintenance going on. So, in this segment right here, they're losing probably a lot of money because you have to remember what they're coming off of. In basically 2021, they were describing the housing market as a white hot housing market. So now I'm going to go over and I'm going to show you their EPS history. So right now we're on macro trends. We're looking at Stanley Black & Decker and we're looking at the trailing 12 months earnings per share. So if we're just looking at this, look right here. This was right around, scroll down a little bit. When they were making $10.86 of diluted earnings per share, that was September of 2021. That was before all of this interest rate hike nonsense. This interest rate hike nonsense, that started in 2022, right around Q1. So when the interest rates were low, people were pretty much buying a ton of power tools, and you could tell just by their earnings per share. They were making $10.86. So yeah, I mean, this is what this stock can do when the environment is good. So this is a very cyclical stock, a cyclical company. Now, let me just show you the very negative earnings report that we got. So in their last earnings report, which was actually their annual report, their 10K, we got this piece of news, the 2023 outlook in their investor report, so in their investor letter. So I'm going to go ahead and zoom in for you guys and just read this. So this is going to look pretty darn grim. So it says the company expects 2023 diluted earnings per share to approximate negative $1.65 to positive 85 cents on a GAAP basis. So generally accepted accounting principles. Now, if we're basically going to do this in a adjusted, they're looking at $0 to $2. So this is a pretty big range. So what this is pretty much saying is that there's a lot of uncertainty here. They don't really know how bad the economy is going to be, but they're giving us this guidance of the full 2023 year, and they're telling us, hey, you know what? We're either going to be negative or we're going to be slightly positive. So you have to think this is really, really bad because they were making a ton of money, but now they're telling us, hey, you know what? We might actually lose money. So let me just go ahead and show you their 2022 earnings. So for the full year, they made $6.76. Now for the year before that, so 2021, that was $10.16. Now 2020 right here, that was $7.46. So you can see just how bad it is for us to go negative. I mean, this is a very, very profitable company, but they're undergoing a hard time. So like I said, if this is a cyclical company, you want to be buying when the economic outlook is not that great. So, obviously, if they give us a negative earnings report, and let's say that for the full year of 2023, that we lose money, well then, yeah, the valuation isn't that great. But if you're expecting, hey, you know what, maybe Stanley Black & Decker can get back to the $6.76 earnings per share at some time, maybe in 2024, maybe in 2025. Well, then right now, this is trading at about $86. So, if you're looking at that, then that would be about a 12 times multiple, or maybe a little bit more than that. So, I personally don't think that Stanley Black & Decker is all that expensive here, especially knowing what I know about how much they made in 2021. So like I said, when the housing market was booming, they were making a ton of money. That was $10 in earnings per share, a little bit more than that actually. So you have to think about this, okay? If the Federal Reserve is going to cut interest rates, and let's say they cut right back to ZIRP, it's going to be 0% again, basically 0%. So let's say that we get there, the economy gets so bad that they just cut the interest rates all the way back to where it was in 2021. Well, then what do you think is going to happen? We're going to have a crazy boom in the housing market, and companies like Stanley Black & Decker, they're likely going to do very, very well. So, we have this earnings report that's coming up. We don't necessarily know if it's going to be good or bad. So if it does fall even more than where it's at, and let's say it revisits 70 again, is that going to be a buy? Well, in my opinion, yes. But like I said, I want to caution you, there are some risks here. And I think the risks are a little bit more near term. But if you are willing to hold this for a longer period of time, I do think that it is going to recover. It's going to be higher than where it is right now. And, I feel pretty confident in that. But like I said, you want to hold a lower percentage, like keep this to like a 1% allocation, because like I said, this isn't a top 10 stock in the S&P 500. These things can crash quite a bit. So essentially what they're expecting is they're expecting the first half of 2023 to pretty much produce negative earnings. And, they're expecting that the second half of 2023 to get a little bit better. So that's essentially what they're expecting for their earnings per share. Now, I do want to talk about one more thing. So let's go ahead. Let's go back. And I want to show you their dividend. So Stanley Black & Decker, they have a pretty nice dividend. It's about $3.20. So right now, it's about 3.7% in dividend yield. But, you might be thinking, oh, that's absolute trash. And why is it trash? Well, it's because you got treasuries that are pretty much giving you 5%. So why would you settle for 3.69%? Well, the idea here is, hey, you know what? If I hold this, I'm going to get paid a dividend. And then, at some point in the future, when that theory that I have, when the interest rates do cut down quite a bit and the housing market picks up again, well then yeah, you're going to see a company like Stanley Black& and Decker that sells power tools, they're going to start doing better. They're going to come out of that negative earnings per share, and maybe they go right back to $6, maybe they go to 7, maybe they go to $8 earnings per share. And at this current price right now, that would be like somewhere between like a 10 to 15 times multiple. So honestly, I don't think that if you were buying right here, it wouldn't be a bad idea. Also keep in mind, these interest rates that we have right now, this 5% or whatever interest rate, when the Fed starts cutting these interest rates, it's going to go down real quick. And these 2-year notes, these 1-year bills, these interest rates are going to fade so quick. It's pretty much you buy it now or rest in peace. You're not going to get it that you're not going to get a rate that great in the future. So you have to think about that. Now, when those yields do come down from the treasuries, then yeah, 3.69, that's going to look real good, especially if, let's say, like a 2-year note later yields like 1% because the Fed cut so rapidly. So you have to think about these different things. There's a lot of different dynamics playing here. So, maybe Stanley Black& and Decker, they report a dismal earnings. Maybe it falls, and maybe, you just buy your starter position. So like I said, you're going to get a dividend. Later in the future, when the Fed does cut rates, because we all know that they're going to cut rates, then a company like Stanley Black& and Decker, they're going to benefit. So hope you guys enjoyed this video, and have a good one.